Thank you for hitting play and checking out another video from NetPicks. And this one, we're going to talk about another trading indicator that comes from the oscillator family, and it's called the Relative Vigor Index, or RVI for short. And actually, it's almost always compared to the stochastic oscillator. The major difference between these two is the relative vigor uses the open and the closing values of whatever you're trading. Okay, the stochastics uses the close and the low value. So is that a big difference? Well, if we think about trending price action, well, when we look at an uptrend, which is bullish price action, we have the closing prices higher than the opening price, right, over a set period of time. Downtrend, the exact opposite, our closes are lower than the open. So the RVI is just a quick way that you can judge the direction that price is moving. So you can see that it has two lines, and those two lines oscillate above and below a zero line, pretty much the way the Copic curve indicator does. And here's the formula for it. It's not rocket science. And of course, you could always change the look back period. So essentially we have the two lines, the red and green lines. And the red line is actually a 4-period volume weighted moving average. And it's generally called a trigger line. The green line, the default setting is 10. And it's a simple moving average calculation for the RVI formula. Now, at first glance, when you look at this, you really couldn't tell the difference between this indicator and other oscillators. And actually, they're often used the same way. But we're going to get into some specific relative vigor trading strategies. But first, what type of trading signals can you get? Well, the most commonly used ones, as with any two-line oscillator, trading the crossovers of the two lines and or the zero line, right? Trend determination or buy or sell triggers. And looking for a price divergence where price heads in one direction and the indicator heads in another direction. Now, I intentionally left out oversold and overbought conditions because really the market can stay in those conditions for a long length of time, and far too many traders get caught on the wrong side. You should also know that this indicator may have some issues with ranging markets where we're not seeing a whole lot of sustained price action in one direction. So due to this, you might want to determine that the instrument you're trading is actually trending. Now, just those 2 points alone, that's enough for any trader to be able to design some sort of strategy that they could trade. I'm going to show you some, but before I do, what I'm not going to be doing is adding in another oscillator type of indicator. Okay? In any trading strategy, when you have two indicators telling you virtually the same thing, it's just redundant. So I want to keep it as simple as we can, right? Complex does not always equal success. So the first one is the RVI as bullish and bearish, divergence. And there's nothing new under the sun using an oscillator for divergence. Okay, it's a tried and true method. This is just a 4-hour chart, and this is an example of bearish divergence. You'll see that price puts in a higher high, while the indicator puts in a lower high. So essentially what we're seeing is just a decrease in the momentum of price. Okay, remember the calculation. And you can position, generally, this would be a counter trend trade, a short-term trade. So the trading rules, quite simple. You just want to find price making higher highs, indicator making lower highs. Okay, this is for shorts. The trade entry can be below the candle that breaks the previous peak. And on this chart, it's that small red arrow. Or you could trade the cross of the green and red indicator lines. Once you're short, your stop loss will go above the last swing high. Okay, it's the red circle. Your first profit target can be the last swing low, and that's the green rectangle there. Now, I didn't show the rest of this chart at this time, but it's actually given up over a 2% drop in price so far. Okay, so if you're looking for bullish divergence, just change these rules around. Okay, they're just opposite. This next one, we're going to use a trend indicator, and we're going to use a 20-period simple moving average along with the RVI, and we're going to have two different trade setups. Now, price is going to also have to confirm the direction as an added confirmation for trade entry. Okay, what this means is our trade entry will only trigger when price breaks a high or a low. So the first one is buyers selling the zero line cross. Now, for this strategy, we want both the red and the green line to cross the zero line. We also want price to be on the same side of the moving average and not touching it. That's a confirmed candle. So this means if we're short, price is under the moving average and the RVI lines are below the zero line. We would consider that a bearish trend. The entries on these would be a break of the high for a buy or a low for a short using that first confirmed candle. Second one is buy or sell line hooks. Okay, for this strategy, considering a buy, we want price above the moving average and the RVI lines above the zero line. Okay, we're in a bullish trend for the buy. A buy stop order would be placed above the candle where the lines crossed each other. Now we're going to take a look at a gold futures chart. This is 5 minutes. Okay, and I did not factor in time of day, as this is just an example of the setups. Some traders will not trade overnight sessions. Other traders will only trade the morning session. Okay. At number 1 here, this is the zero line cross. Price is not touching the average. We buy stop below the first candle that closes when both the red and the green lines are negative below the zero line. At number 2, this is our line hook strategy. The relative vigor index, it's just crossed to the upside, not the zero line, just the lines have crossed. So we're going to buy stop below the candle where the hook closed. So number 3, this is the zero line cross again. The RVI crosses zero line. Price is not touching the moving average. We buy stop the high. Number 4, this is the line hook. You see the lines have crossed and we put a buy stop order. And as you can see here, it did not trigger. Number 5, zero line cross. The RVIs cross zero. Price is not touching the moving average. Okay, we sell the lows. Number 6, zero line cross. Okay, this low is not touching the moving average. We buy stop the high. Your stop loss on these can go above or below the candle that actually triggers the trade. Your profit targets can be previous lows or highs. And I just picked a recent chart for this example. Even in sloppy conditions, as we see over on the left, the strategy does pretty well. Some adjustments you can make when you're using the line hook strategy on a buy setup, for example. You may choose to move your entry levels down when we get lower high candles, okay, instead of leaving it at the first candle. This is actually fairly aggressive as an entry strategy, so ensure that if you do get triggered and price goes against you, you don't hang on for too long. When taking trades using the crossing of the lines, okay, that looks enticing, right? But you might find too many false signals that will cause quite a few losses if you're just using those to trigger trades. If you're using the RVI during a price range, I personally would consider using the divergence trading strategy depending on how tight that trading range is. At times, you might just have to use a standard trading range strategy. The conclusion, I think it's a pretty versatile indicator. You can use it much in the same way as any other oscillator out there. It uses 2 lines, the red and green line, and the zero line, which determines a bullish or bearish trend. And really, you can pair it with another indicator. Just make sure you're not getting redundant information, okay, by using 2 oscillators, for example. Any market, any time frame, it works fine. But ensure that you have a solid understanding of the strategy that you plan to use. I want you to test it out on numerous charts and time frames that you plan on trading before you ever think of putting any money on it. That wraps it up. Take a second, if you hit subscribe there, like this video. If you have any questions or comments on these setups, leave them below and I'll respond. Thanks for watching.